Financial crisis equals opportunity if you, like me, lived through 1973-74 or even the early 1990s. There was a waiting list to get out of the country club. That's when you know things are tough. If you live long enough, you'll see it. The United States experienced an economic recession in 1973-74 and again in the early 1990s, which brought on unemployment and crashing stock prices. The 1973-74 recession was caused by a rise in oil prices. It lasted 24 months and caused the Dow Jones Industrial Average to lose 45% of its value. The early 90s recession was also caused by rising oil prices, but also by overbuilding in the 1980s, which caused a slump in office building construction. The recession lasted 8 months and caused the Dow to lose 18% of its value. In 2001, 6 years before the Great Recession set in, Charlie knew that there would eventually be another great economic upheaval. He was correct. In September 2007, the economy collapsed, stock prices fell, and the Dow lost 54% of its value. How did he know that would happen? He knows that cyclical financial crises are just in the nature of capitalism, that a heavily leveraged banking system, when mixed with speculative frenzy, can create massively unstable investment bubbles, which inevitably burst and bring the entire economy down. I would be amiss if I didn't point out that random recessions or crashes are programmed into Charlie's buying strategy. Both Charlie and Warren let cash pile up, waiting for a recession or crash, even if it means getting low rates of return on their cash holdings as they wait for the inevitable. When the crash hits, they make their purchases. In the 1990 recession, bank stocks took a big hit, which Berkshire used as a buying opportunity to acquire 5 million shares of Wells Fargo Bank at a cost of $289 million. Today, those 5 million shares, thanks to stock splits, have grown to 40 million shares that are now worth approximately $1.9 billion, which gives Berkshire, excluding dividends, a 7.5% compounding annual rate of return for the 26-year period. But the icing on the cake is that Berkshire's original $289 million investment is now earning at $59. $2 million a year in dividends, which equates to an annual dividend payout of 20.4% on its original investment. As Charlie has said many times, it wasn't brains that made him so rich, it was temperament.